welcome to the stage Rob Antulov, Managing Partner Australia at Modus Partners, discussing the right investor for a successful exit.
Good afternoon or good morning. I'm not sure. I think we've just about at midday. Lunch is just around the corner, so I won't hold you long. Fish where the fish are. Just as an indication, how many of the people in the audience are fishing for investments? Who are investors in the room, roughly? And who are fishing for capital? Who are entrepreneurs or founders in the room? Okay, cool. Both, both. This discussion is going to be a little bit more qualitative than the previous one, not quite as much analysis. For those of you looking to raise capital, for those of you looking to invest capital, the thesis of this discussion is more around taking money from the right investors rather than just taking money from capital that's available. And that theme applies both from an investor's perspective, but also importantly applies from the entrepreneur's perspective. So sources of funding. Primarily talking about equity funding. Founders typically provide the first dollar of capital for their business. Friends and family typically provide the first external funding for a business. So people who know the entrepreneur are more likely to provide the first external capital, become the first shareholders on their register. Angel investors typically come in a follow-on round, a seed round or or Series A or pre-Series A. Angel investors typically high net worth individuals, possibly corporate executives, possibly former entrepreneurs who are looking to invest back into growth companies. Venture capital, you understand venture capital funds, typically, again, high net worth investors investing into a managed fund managed by investment directors, professional investment managers. Strategic investment will come from corporations. Sometimes those companies set up their own corporate venture capital funds to invest in earlier stage businesses. Family offices managing ultra high net worth individual money, high net worth families, intergenerational wealth, etc. Typically invest in a wide range of assets. And then private equity, and we've just heard a lot about sort of private equity as a broad category, and then private equity funds tend to invest in more mature businesses. There's other sources of funding for businesses as well. Obviously revenue, so businesses will bootstrap and then run their businesses through their own profit. There's ability for entrepreneurs to take loans, either as bank debt, potentially as convertible notes, etc. So there's other sources, but primarily we're talking about equity investment today. So a key for an entrepreneur and sort of the corollary for an investor as well is to prepare well for the capital raise journey. Every entrepreneurial adventure is unique, and it's really important for the entrepreneurs and the founders of the business to understand their own personal goals, what they aim to do over the next few years as they grow their business, and importantly, what their exit aspirations are, and to understand what the goals of their venture are as well, so the business itself. The entrepreneur needs to understand their business, know it well, know what their growth potential is, know what their limitations might be, having a really good understanding of the industry they're operating in. That'll help them understand who the best investors may be to assist them in growing their business. Understanding how much capital to raise is a critical point. Not raising enough runs the risk that you run out of runway before you get to the next critical stage in the business. Raising too much runs the risk that you dilute your equity in your own business at a lower valuation. Each investor has their own criteria, so getting to know their investor targets is really critical. Those criteria can be different for different investors, clearly, and they run a spectrum of different characteristics. These are just some, it's not comprehensive. But clearly some investors have different criteria on their timeframes, how long they'd like to hold their investment, different sector preferences or stage preferences, whether or not they prefer to be a lead investor, to take a majority of the investment in the company, or whether they're happy to be a co-investor or a follow-on investor. Whether or not they're willing to invest only in businesses that are in the same location they are, or whether they're happy to invest in other locations. The amount of money they're willing to invest, whether or not they've got capacity or capability to follow on invest in subsequent rounds. Whether or not they want to have a stronger influence over the direction of the business in terms of governance, whether they want a board seat or not. So there's a whole range of different criteria that investors will put on their own investment frame. And it's critical for the entrepreneur to match their own preferences and those of the company against the preferences of the potential investors. Now, again, not comprehensive. The sliding scale is just indicative. There's no right or wrong in this, but there's an imperative for the entrepreneur to understand how best to match their own requirements against the requirements of the investors they're speaking to. And a simple example is if an investor wants a return on their investment within a 2 to 3 year time frame, but the entrepreneur believes that it's probably 5 to 10 years before there's likely to be an exit, then there's a clear mismatch, and that may lead to problems later on. Some entrepreneurs may want an investor with a strong experience in that particular sector. Other entrepreneurs may be less concerned about that. Some investors may have experience in growing businesses and exiting businesses, and that may be useful for an earlier stage business. Some investors have got the desire to take a majority stake in an investment round and therefore be the lead investor. Others are happy to take a minority stake and be follow-on investors. So there's a range of different attributes, and it's really important that the entrepreneur and the investor match against these attributes. So finding that fit is really important. The comment about personality fit is really interesting. It's hard to quantify that, and it's something that just that the entrepreneur and the investor get a feel for as they interact, as they have their conversations around the investment opportunity. But the idea of a personality fit is really important. It's important that the entrepreneur can feel that they have the ability to call up their shareholder and have a conversation with them about it. If they don't get on, that's less likely to happen. There's less likely to be value added in that interaction. That fit may be more than just direct personality. Clearly there's sector expertise or there's stage expertise. There's got to be a fit or an alignment in an understanding of the strategy of their business. You want the investors to align with the business strategy of the entrepreneur. And you want alignment around whether or not the investor will be an active participant in the management and the governance of the business, or whether they'll be passive. Now, again, there can be circumstances where either is preferred, and so there's no right or wrong, it's just a question of matching. So this philosophy of having the right investor is a really important one. That once the investor is on your cap table, they're on there for the long run. It's quite difficult to exit an investor if you're an entrepreneur and you're not getting on with that investor. So the right investor philosophy should be put in place from the very first external capital you take. Even if it's friends and family, you still want to be clear that there's alignment in those values. Alignment with investors will deliver better outcomes overall, better decision making, less distraction. And the corollary is that if you have the wrong investor, it can be really time consuming for the entrepreneur, and there's potentially destruction of value along the way. Just very quickly on the idea of having customers as investors, because that comes up a reasonable amount. Sometimes direct-to-consumer businesses can embark on a crowdfunding campaign to get customers as investors, but they're generally very passive. But other situations you can have either direct customers or potentially distribution partners in territories that the business doesn't operate in seeking to become investors in the business, and that can be a good thing because those customers understand the business, they're probably consumers of the product or the service, they're probably complementary in sort of the ecosystem. But that can also have negative consequences. It might be harder to pivot a strategy if you've got a customer as a shareholder. It might influence negatively the exit options if you've got a customer as a shareholder and they're reluctant to let one of their competitors become the acquirer of the business. I won't speak too much to different exit scenarios, but typically a trade sale is the most typical exit for growth businesses. And in that scenario, generally all the shareholders will receive the same type of outcome. Generally, it'll be a complete sale. Some of the shareholders may have a differential outcome. There may be preference shareholders, or the owners or the founders may have an earn-out, for example. The financial exit is where there's another financial investor who comes on and buys out one of the existing, or one or all of the existing shareholders. So that could be a private equity scenario, or it could simply be a secondary share sale scenario. A merger is where the the entire business may be exited, but there may not be a cash consideration. The consideration may be in scrip of the acquiring entity. And obviously an IPO where there's an opportunity for an investor to potentially hold some or all of their stake or sell some or all of their stake into that IPO. So importantly, as I said, the theme is don't just take funding from any source that's available. Shareholders and the relationship that you can build with shareholders and the value they can add can very positively impact both the growth of the business and also the ultimate exit of the business. Understanding the value that industry connections can have, that sector experience can have, can be really valuable for the entrepreneur as they're building their business. So it's important to find an investor that meets those requirements. So a truism always when raising capital is raise before you need the cash, and that's really critical. It's important that entrepreneurs get to know their potential investors before they need the cash and before they embark on the capital raise process. For entrepreneurs to do that, they can speak to other business owners, other entrepreneurs who have been through a similar process. And it's important that an entrepreneur develops a sense of what their preferred terms would be in a capital raise, so that they've got a view of what that is as they go through the process. But it's also important for the entrepreneur to be flexible and take feedback because their own views may not match those of the market. This is more for entrepreneurs, I suppose, but for entrepreneurs, avoid investors who don't agree with long-term goals. I suppose that the flip side applies as well. For investors, don't invest in entrepreneurs who don't match your own long-term goals. Avoid onerous terms for investors, particularly in the early stage, or at least as investors, avoid placing onerous terms on entrepreneurs in the early stage. And avoid term sheets that might heavily favour the investor because there's a risk then in tough times the entrepreneur gets disillusioned. So in summary, understand your criteria, understand your investors' criteria, and then make sure there's an alignment between those criteria. Make sure there's a match between expectations on both sides. At different stages of the business journey, different investors will provide a different outcome or beneficial outcomes. Understanding those differences is critical for a successful capital raise process and beyond, and growing the business and delivering the successful outcome. So having the right investors will have a compounding effect on the growth of the business and will help you optimise your exit.